For those of you who may not have talked or spoken to QwickRate in a number of years, we've been doing, certainly non-brokered funding for 30 plus years, but more recently have developed some additional solutions, including IntelliCredit, and that's David Ruffin joined us in 2019. So we're very excited about some of the new things that we have. Today, we're going to talk a little bit about data. I mean, it's a wonderful presentation that Scott does. It's in some ways very difficult to follow his presentation. But, I think what we're going to try to do now is maybe, look down the funnel a little bit more and take a lot of the information and talk about the information that we do get and how do we, kind of maybe tailor that more to, activities and planning and strategic planning specifically around the bank and your bank. So these are some of the things that we'll touch on as we move forward. I don't want to spend a whole lot of time on decision making. I mean, I think we all know how important the role data plays, but I think it's a good reminder when we think about it within the bank, and I always think is, just defining the objectives that you want data to play. And then I think the other thing that we are big believers in, excuse me, is we believe your time at the bank is obviously better spent analyzing data rather than aggregating it. So I think trying to find solutions and tools and sources of data where you can spend more of your time focusing on analysis and understanding and explanation rather than aggregation is something we should all continue to strive for. In addition, again, it's a great way to continue to monitor progress we're making in the planning process. And then the final thing that I would say, I believe the wonderful thing about data is hopefully it helps guard against biases. I always like to say data is the great arbiter of truth. We can all have points of view and opinions, but at some point, it's important that the data and the numbers actually drive the decisions that we make. And so I feel like that's always something that I keep in the back of my mind and always try to keep as somewhat of a compass to make sure that the data is really, really where we're settling what's fact and what's fiction. The strategic planning process, again, for you, all of you do it, you're running successful banks. I don't want to suggest I have a better way of doing it, but, I'm kind of a simple-minded person, and so I always try to, probably take the most simple and direct approach when possible. And when I think about strategic planning, and particularly even I'm a director in a small community bank in Illinois, we always, think about the fact that the director should develop the plan, set the objective, set the plan, and then it's management's job to execute the plan. And our feeling then is data is how we all effectively and consistently can monitor the progress that we are making as a group to those objectives. And so again, I think that's where we really believe having agreement and having understanding within your organization about where data is coming from, the consistency of it, the distribution of it, and the understanding of it becomes increasingly important. And when you have that, it can become a force multiplier, which I like to say, it just improves the effectiveness of a group. And I think oftentimes, particularly at I think in the banks, we've done a very good job over the past decade and certainly post-crisis or post-recession of really improving the way we bring data into our banks and to our directors, the distribution of it. And now I think, again, it's a continually refining process to improve the data that we're putting in front of our directors and our management team. And so, this is kind of in a nutshell how we think about, or how I think about strategic planning. I think, again, I kind of alluded to this a second ago, but I also think it's important to recognize, does data drive your point of view, or does your point of view drive data? Again, this kind of circles back to being an arbiter of truth. I often feel that this is often, whatever the answer to this question is often how data gets digested and implemented and utilized within an organization. I think we've all been in rooms where oftentimes the loudest voice wins. And I think importantly going forward, it's critical that the data is really what's driving the decision and the information for our organizations. And in the banking sector, we have, needless to say, reams of data. Again, while no one enjoys filling out a call report, I do believe it does give us a special advantage in our industry of giving us good apples to apples, consistent information that every bank in the country is completing. It gives us information about our competitors, ourselves, the industry, that we can actually go out and get real live information, to better do research, to self-evaluate ourselves, do SWOT analysis, understand regulators' point of view. All this can be done, in a much more easier fashion than almost any other industry in the country. And particularly now in the age of, of cloud-based solutions, the internet, there's so many ways to get this information delivered to your organization seamlessly and effectively. I think it's a missed opportunity for a lot of institutions if they're not taking advantage of what this, this readily available data is that's out there for you. The next area, though, I think where we're moving, and many banks have already probably moved to this point, but is really the harnessing and the harvesting of your non-public data. And that's really, kind of drilling down into your customers' information and creating a system or having tools that allow you, your credit team, your entire organization, really see globally, but also down into the more granular pieces of your loans, what's happening. And I think particularly now, as we start what appears to be, a little bit of a longer credit tail here, I think it's probably more important than ever that we are able to identify any risk migrations or degradation of credit as early as possible. David will touch on this in a little bit, but certainly being out in front was a lesson learned from last time, and again, we think is certainly prudent planning for this time around. So, I think the next thing is how do I incorporate technology into our bank? For many of you, you've probably listened to a number of different presentations from technology providers. The ICBA's got a venture center going now, so there's all kinds of these fintechs that are trying to bring efficiencies to our bank, which is wonderful. In fact, there are more fintech companies out there today than there are banks. But I think it's also important to self-assess our institutions to identify technology that that can be a force multiplier. And what do I mean by that? It's one that can grow with you, that can be implemented by your team, integrated and understood. I think one of the real strategic challenges for all of us is if we do at Quick Analytics, we do a high-performing bank analysis every year. And for the last 4 years, you won't be surprised by the fact that the most highly correlated component to a high-performing bank is efficiency ratio. And furthermore, for those banks that have the outstanding efficiency ratio, they tend to pay their people more. And the conclusion that we draw from those correlations are, if you give your good people the tools they need, they will be efficient and drive the productivity that you need. So anytime you're discussing incorporating technology into your institution, it's critical that you have the belief of A, can we implement this? B, will our team utilize it? And 3, will it be understood by all of them? Because if it doesn't matter what the technology is. It's going to sit on the shelf and not drive the productivity that you're looking for. So I think it's one of the most critical strategic decisions when you're incorporating technology. Then is again, we all want to have the shiny object and the new piece of technology, but a lot of times it's better to do an evolutionary trend and a refinement than a revolutionary refinement, because again, you got to make sure you have a technology that you can easily implement within your organization. So one of the ways that we thought about talking about just kind of this process is reserves. Right now we're at a time where as Scott presented, there's all kinds of information and there's a lot of things different this time around than last about where we're going and where the economy is and what the impact is going to be to the banks. And so we thought it was an interesting example, maybe just to look at what's happening with some, as we see it, with reserves today and how you might be thinking about it. We do believe that obviously we're at the start of a new credit cycle. Does it look familiar? Certainly, excuse me, are we able to learn anything from last time? Again, being a little bit simple-minded, I've been watching what some of the larger banks are doing to prepare, for the uncertainty ahead, knowing that they have far more resources and technology than I do. And while it may not necessarily be completely relevant to my local market, it does give me a little bit of a tea leaf of where they think things are going, and maybe it can help me develop a better plan. But first and foremost, in a year, you always think about 2020 vision being perfect vision. Certainly this year has been anything but, and I think Scott had a similar slide, in his presentation. But I think it's important to remember that the path of the economy is going to, is really going to depend on the course of the virus. And so the progress we make there is where we're going to see economic recovery. Certainly, there's been a disconnect from the stock market and the economy, and that's certainly masked some of the kind of real pain that's happening in segments of the economy. But I think this is important to remember as we move forward. And it's certainly something we can all visually kind of identify where our communities are in this process, and just get a sense of, are we making, even in our local areas, progress in dealing with COVID. I don't have to remind anybody of the economic impact that COVID has had. It's certainly been severe. It's been abrupt. And certainly we're all going to try to deal with it as best we can. But I think one thing that's been really important to note this time around compared to last time is the amount of fiscal support that has already been introduced into the economy at a much earlier point in time than last time. So you'll see the two graphs on this page, one showing the aid from the fiscal support, monetary support from the last recession. And you can see it took over a year for money to get into the economy. This time it happened within months, and it's far more significant than what we saw last time. So that clearly has implications for, prolonging and maybe pushing back, if not completely solving the problems for some. So I think it's important to remember when we think about this time versus last time, there has been a huge difference in the amount of support provided to individuals and the economy. There's no question there's a correlation for delinquencies and unemployment. Again, the Fred data site is a tremendous source of information, but you can see here the huge spike up in the unemployment rate. We haven't seen the move up as much in delinquencies yet, but it's hard to look at this graph and not think that there's a move, pretty significantly up. How high? Who knows? But there's certainly going to be a movement upwards. As I mentioned, the amount of support has been tremendous. If you think about the CARES Act, $2.4 trillion, and it was implemented within weeks of the downturn. And you compare that to $800 billion last time around, and that was only introduced only after I'm sorry about that. After the over 12 months after there was an initial downturn. The Fed funds rate in 2007 was over 5%, and it took over 6 months to get to zero. Certainly here, we immediately moved to zero again within months of the identification of a slowdown in the economy. I think this time it's clear rates are going to be lower for longer, and that clearly has implications for our margins. Last time, it was once the support was introduced into the economy, there was a great fear of inflation, and so at anywhere where we got near 2%, we started to discuss and then did in fact raise rates. I think it's been clear even in the comments of the Fed in the last couple of days, they're going to let inflation run, and we're not going to wait to see it. We're actually going to experience it before they probably move to raise rates. And so again, those are serious implications for us in our margins. Certainly the fiscal support has been really strong early. It will be interesting to see how much more is coming, but there's certainly going to probably be some more support because it will again help continue to keep the economy moving, and so we don't have a double dip of a recession. One final slide on what the support has meant. You can see the drop in compensation and just the impact on proprietors, and then the blue bars represent all of the support. So while there was a huge hit to the economy because of COVID, the fiscal support has really been quite quite tremendous, and again has masked some of the immediate pain that our borrowers and just individuals might have experienced. So let's bring it back to a little bit about the reserves and just our industry. Certainly, if you look at what bank investors have done to bank stocks, they certainly believe that there are implications for COVID-19. Year to date in July, the Nasdaq Bank Index is down almost 30%. The KBW Bank Index was over 30%. But we've seen real big drops and hits to bank prices that have not recovered as the rest of the stock market has. So there's certainly a little bit of a wait and see here about what the true impact is going to be to banks. The stock market, though, as we all know, has continued to move higher. Certainly the FANG stocks have really driven that. The S&P 500 is a market cap weighted index, and so that has they are all up very, very large, big numbers this year. But they also, I think, the other implication that has me a little bit more concerned, is it suggesting something that this might be more of a normal, where larger institutions in different industries take market share. If you think about how often larger institutions work, they're going to try to grab market share during times of uncertainty. We see that with banks. They're larger banks, the money center banks. They're willing to be a lot skinnier on margin. Wells Fargo introduced today, you saw it on the Bloomberg, a no fee overdraft account, right? They're going to use their balance sheets to try to grab market share. And so that certainly has implications for all of us. It certainly has implications for small businesses. Can they afford to, how long can they afford to stick around? So there is a huge disconnect between the economy and the stock, and I think that's also important to remember as we're making decisions for our bank. So back to JP Morgan and what they have been doing. So these are the last 6 quarters. This is all call report information from Quick Analytics and JP Morgan's call reports. And you can see starting in March of 2019 where their loan loss reserve was and where it is today. They have in 5-6 quarters really made a precipitous move with their reserve. And if you compare that to what they did last time, you can see it's not quite as severe or as large as last time, but they clearly see problems down the road. And I think it's a good, it's good information for us as we're identifying what is going to happen this time, is to look back at ourselves, look at our competitors, and identify places where we think that loan loss reserve needs to go. So again, what can we do to develop a plan for ourselves? Again, do we have the data available to us? I think some of these things are the points that we're trying to make. Do we have tools to identify early weakness in our borrowers? Are we scheduling loan reviews and making sure we're identifying the borrowers who we need to check on, and those loan review specialists are experienced? Should I run a portfolio level credit stress test? What's my capital cushion? What kind of cushion do I have to guard against losses? I think all of these things will be helpful to make sure that we all weather the storm as effectively and efficiently as we can. So just a couple of more slides before I pass it off to David. Again, one of the things that we try to do on a quarterly basis is just put information together in Quick Analytics about what's happening across the country, but also at the state level, and put it in ways you can easily see. So here's a couple of graphs on non-interest income compared to average assets for the state of Florida versus the national trend. You can see the number drop pretty precipitously and has been below the national median for a few years now. The efficiency ratio has been coming down here in the state of Florida, but still slightly above the national trend. Yield on loans, again, we've seen, with the drop in rates, the pricing on loans has gotten extremely competitive. Cost of funds, we've seen a precipitous drop. It's probably a good reminder here that even at QwickRate in this unprecedented low interest rate times, if your local market's been slower to react, there is plenty of wholesale funding at really inexpensive rates, and particularly at longer maturities where you can actually attract funding if that's something of interest to you. And then finally, I think the more concerning thing is when we look at NIM, right? So we've already seen a downturn in NIM. Again, a lot of that's already accounting for the reserve buildup that we're seeing. But how this goes and how long this, whether it starts to moderate or continues to drop is, I think, something we're all, certainly cognizant of and certainly need to be watching. At this point, I'm going to pass it over to David.
Well, I'm glad to be here with you, with a great friend, Paul at Saltmarsh. You have a fantastic group today attending, so we'll carry on. There's been a lot of discussion already from certainly Scott and Shawn relative to the economic impact. So I'd like to kind of pivot a little bit to credit impact, because I do feel like this is a little bit of a conundrum that we're dealing with relative to that, because it's not just a matter of economic issues. I think credit is a little different animal, and I think that's what we wanted to talk about today. Part of that is the fact that we've got an example here in just the month of July that roughly 32% of either a combination of mortgage payments and rent payments were delinquent in the month of July. I think, as it's been alluded to already, we've got a correlation issue relative to the trailing indicator of credit, which obviously in this chart would be delinquencies, but even bankruptcies would be trailing the unemployment. Even though there's been some improvement in the unemployment, I think we have to understand the trailing aspect of this so-called credit tail. But I think one of the most impactful slides that I've seen, and really is a segue to a lot of my presentation today, is the fact that we had delinquencies in the month of May beginning to really show markedly in, say, retail and lodging. And why that's interesting, because of course that's intuitive to all of us listening to this, is that this event, unlike the last crisis, so to speak, which was really driven a lot by wonderful family valuation collapse. In other words, one industry kind of led us into the Great Recession, right? We're now having to deal with a whole multitude of industry impacts, and I think that makes this a more complex issue to deal with. So what are some of the issues we're faced with? I think we are talking about uncertainty. I know for a fact that the investment banking world tends to feel like they're in a very strong sense of uncertainty around where the other credit shoe will drop. I do think that's going to require us to dust off our game plans on credit risk management, similar to what we were doing a decade ago, but in quite different ways that I'd like to talk about today. There are clearly some signs of snapback, which we all pray for, but there are also spikes, and it's been said again twice today, the course of this economy will likely follow the course of the virus, which lends itself to the uncertainty. As Shawn just alluded to, I wanted to make sure that we understood the distinction between Main Street and Wall Street. Credit stress always has a trailing aspect to any kind of economic shock. And I think most of the bankers on this call today, frankly, live in Main Street, not Wall Street, relative to what really the direct impact of our credit quality in our portfolio is. And as has been alluded to a couple of times today, that there is a bit of a disconnect. I know Wall Street tends to dominate and lead in terms of the news about where the economy is going and so forth, but as Shawn indicated, it's very tech heavy and doesn't necessarily relate to a lot of the issues that we're facing on Main Street. I would almost add that there's a bit of a sugar high going on with COVID in the banking world, and that is because of the non-baseline lending activities, particularly through the PPPs, which is really a non-permanent growth, masked embedded credit quality, because even the use of extensions and modifications have, I think, artificially reduced the embedded credit risk. For example, I looked at, you see a lot of state-specific and regional-specific data today that will show you that kind of indicated the state of West Virginia, for example, basically eliminated much of their non-performing loans, what looks like because of the use of extensions and modifications. And we all know that once that time period expires, then we're going to have to start looking at individual credits as to whether or not they are survivors from this event. But I think irrespective of this, we have of the temporary regulatory relief and all of the stimulus that Shawn was alluding to, we just have to realize it's going to be incumbent on each and every individual bank to assess its own credit risk profile, and most importantly, write your own script. The worst thing you can do once the regulators get back, I think, into a much more normalized examination mode, is to kind of take the approach, well, this event was ubiquitous, it was beyond our control, and we don't really know what's going on. No, you are expected, I think, and will be expected to understand what is unique about your own bank's portfolio and make sure you're writing your own script before a regulator does it. Now, there's some good news, quite a bit of good news in a sense of comparison to a decade ago's crisis. We certainly got more capital, we've got more liquidity, we've got better risk management practices, and with the short-term and deposit growth, we've had some tangential benefits from that. And perhaps as importantly as anything, there's no blame that could possibly ascribe to the financial industry about this crisis compared to what was touted in some corners a decade or 12 years ago. So let's talk a little bit about some of the data compares. I tend to take, as Paul Allen has heard me say many times when I'm speaking there in Florida, I tend to take three very basic metrics, one being an inventory of your acknowledged problems, and it begs the question of what can you do with them? You can either charge them off or reserve for them. At IntelliCredit, we tend to be more precise in the region. We tend to be more South Atlantic coast, but because of the number of attendees on this Saltmark conference that were in states like Tennessee and Georgia and other southeastern states, we expanded this data. So what you'll see throughout the presentation is Florida specific metrics, and then the broader Southeast QCBI, and then national. Now, QCBI, to those of us in the Quick Analytics and IntelliCredit family, is really banks with assets under $10 billion. We think that makes for a far more interesting compare, and I think it would certainly speak to those that are on this call today. So nothing above 10 billion is being skewed into these numbers. But so let's take a look. In this case, Florida is actually in the blue line. The burnt orange is the broader regional, and then the national is in the green. So Florida actually has a slightly lower level of NPLs than both the region and the nation, and that's certainly a positive given where all of us, and I'm speaking to you today from Raleigh, so all of us in the Southeast know the pain that we went through in the financial crisis a decade or so ago. So that's very good news. Charge-offs, again, is not very consequential now. Reserves, as they say in the parlance of the day, the curve is bending. I was intrigued by what Paul shared with us, or with me, right before this presentation, and that was that we had about 3/4 of you in the poll said your reserves as of, I guess it was as of June of 2021, would be somewhere between 125 and 200 basis points, which frankly doesn't surprise me, but that's pretty much it. So another way of looking at it from my point of view is how much of your reserves currently are covering your acknowledged problem loans. And Florida is pretty much lumped in there together with the nation and the region, and all being over 2 times coverage. Growth, significant amount of growth 12-month average, these are quick analytics numbers, showing a very, very strong growth through the second quarter. Again, much of that, almost all of that, is what I call non-baseline loan growth. That much of it came, of course, through the PPP loan program, and much of that won't be around. In fact, I think there was a statistic that came out just last week from a federal regulator indicating that the origination of small business loans, in other words, new traditional originations, not in any way related to PPP activity, actually was slightly negative on a year-to-year basis as of second quarter. And the growth, even in Florida, looks like it's primarily in the 250 to $1 billion size loans, or loans of banks rather. Current credit environment, I'm a big believer that commodity valuations, and this is again important because I think this event we're living in now, the commodity credit environment, is going to force us to differentiate industry by industry by industry, business by business by business. And the underlying product of a business tends to be its commodity, and that's a broad terminology. I'm not trying to harken back to the days, and I hope nobody on this program thinks that I would be advocating for return to just collateralized lending. That's not my point here. But the underlying commodity of a given industry basically is a telltale sign for where credit quality is going to go. For example, we all know that wonderful family residential housing collapse and the valuations in that basically led us to the last Great Recession. At that particular point in time, there were banks in Texas and Louisiana, for example, that were faring very well and comparatively well because energy, which was a predominant commodity in that region, was clearly much healthier than, say, wonderful family housing. So I think understanding where that is within the various industries that you're lending to at your bank is going to be important, and thereby creating and quantifying your own unique idiosyncratic credit risk profile. Where does that begin? I think the real art of credit risk management is in risk grade migrations within pass. Shawn alluded to the very whole reason that IntelliCredit was frankly formed was this focus on getting ahead of the credit risk curve by looking at your own bank's non-published idiosyncratic data. For example, if you're waiting until loans become criticized classified, which show up in a call report, as the old saying goes, those horses are out of the barn, and it may be too late to manage those or mitigate some of that. The real art of credit risk management is understanding where risks are migrating within your past categories. Again, no questions at all. The name of the game today is industry subsetting of your entire portfolio using NAICS codes to identify that, and actually, in effect, treating your portfolio as a whole conglomeration of subset portfolios relative largely based on the industries. Certainly, Chris Marinac, I'm sure, would attest to this. One of the lessons, the harsh lessons we learned in the last crisis was the effect on vintage lending, which means basically that unfortunately the most toxic loans tend to be loans that were made on the last year or two of a healthy credit cycle. It just empirically has been proven over and over to be that case. So understand where you were in lending activity pre-COVID, and certainly pre any weakness from an economic standpoint. Very important. Obviously, concentrations and correlations. Many think of those in terms only of commercial real estate or acquisition, construction, development lending, but it really behooves us all to be much more focused on, again, concentrations and correlations within our entire portfolio. Correlations are important because they're kind of indirectly related or related borrowing or businesses. It was not just the tract building loans that went down in the Southeast that caused so much pain and bloodshed in the banking industry. It was everything related to housing that had such a downward draft. By now, hopefully that most of your banks and most of your boards are looking at some type of quantifiable heat map or um, or, or dashboard that shows your concentrations and how you're performing within the broader categories of growth, quality, and yield. But in some cases, we stop there with, yeah, more and more sophisticated kind of peel the onion, here's the detail. What I think is critically important, and particularly now going forward, is to add to that quantification a qualitative explanation or narrative of where you are as a credit risk bank. In other words, what is going on in your portfolio, and certainly with your relative to your concentrations. In terms of concentrations on the two traditional ones we look at, which of course comes under regulatory guidance, it's not a regulation, it's a guidance. The 300 rule of the broader CRE to risk-based capital, as you can see, only 12 banks in Florida are exceeding that as of the second quarter call report data. It does lead the region and the nation a bit on that. On the other hand, of construction development and the 100 rule, there's only one bank in Florida. For the larger Southeast region, that is a little ahead. That's 63 banks. But again, the real question there is if you're in those, even approaching those guidance levels, it would certainly behoove you to explain your rationale and defense for doing that. Again, as an indicator of in understanding just not real estate as your concentration, we've used a couple of 3 slides here. Multifamily, which has a national interest and had for sometime even before the COVID, is potentially a bubble that was building. The national average is ticking up a little bit. I think some of that's PPP. But speaking of PPP, certainly the C&I spike was anticipated and has been very stark. Again, much of that is not baseline loan growth, and can't be and is going to be challenging, significantly challenging for banks and strategic planning around what loan growth in real terms and in a baseline or organic way is going to look like in the next 2 years because of this kind of artificial spike that's gone up because of the stimulus and PPP in particular. Ag is not an issue significantly in the Southeast as it is in the Midwest, as you know. So red flags. What I would urge, again, this is not to be intended to be a doomsday kind of prediction. I think it's just a matter of just trying to dust off and be vigilant about credit risk sensitivities. I hope you take it in that vein. But I do think, and again, Paul has heard me say this many times, I think one of the biggest traps we have as bankers is to think all loans are good loans until they're bad. And some of that is indirect residual of the public call reports structure in terms of reporting publicly. No one likes to lead a parade and showing problems. But again, remembering that the real art of credit risk management is understanding where credit risk is beginning to bubble up well before it becomes a public knowledge issue, I think is the real way you can begin to control and mitigate losses. I think some of the immediate credit concerns, certainly service industries, probably anything other than grocery stores could be argued to be in some degree of stress, although there have been some winners that have emerged, as there always is in times of economic stress. Conventional retail, it's not, most people on this call probably have very little at stake in the big box retail malls, but much of the whole industry of the so-called small strip centers, I would argue 80 to 90% of those are financed at the community bank level and have to be looked at in terms of potential. LFTs are not a factor in the Southeast hardly at all because there was enough organic loan growth. That's a problem primarily in the mid-Atlantic and the Midwest, where they look to these little slices of syndicated loans to enhance some loan growth. Nonprofits is a unique kind of story, and that is even before COVID, it had probably unintentional negative results of the 2017 Tax Reform Act, which basically doubled the standard deduction, and Barron's estimates that as much as 68 billion reduced charitable giving occurred in tax year 2018. And those of us in the credit world know that's top line revenue for a nonprofit, whether that's a small college, university, a religious organization, the YMCA, whatever. And just a couple of weeks ago, we saw that there was a study that over 500 colleges and small universities were showing signs of financial strain. And why that's important is that many community banks, perhaps some on this call, have been reaching out to nonprofits and small colleges and universities over the last few years to frankly diversify away from just traditional real estate. Agriculture, as we talked about, but that's not a big issue in our region. Consumer credit, Scott Hughes said a moment ago from the Fed, it's consumer, 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 the focus. Well, we know that losses in the last few years have been upwards of 80% to 85% in commercial banking come from consumer paper. But there are some community banks that have taken on some exposure in the last few years, particularly in automobile paper, that I think does merit some concern. There's certainly been some heady rises in CRE valuations even before COVID that I think the entire landscape of CRE may have to be rethought. Things like office space. We're in a revolution now as to how, well, in the very sense that we're speaking to each other today and that by this means remotely and virtually. That's certainly revolutionizing a lot of office and workspace. But again, for probably the third time, I'm going to remind us all that one of the huge red flags is not determining, not quantifying, not describing your own credit risk profile before a regulator does it for you. In all due respect to the regulatory community, because I live in a kind of symbiotic relationship with regulators, is that they respect and want you to kind of describe your own situation, but they can fill a void very, very quickly and do. And then there's recognition that there is a structural disadvantage that community or smaller banks have to dealing with NPLs or NPAs when they emerge. We all remember, again, the Texas ratio shot up, of course, after the financial crisis. And then there began to be somewhat of a delta or divide that emerged between the big banks and the small banks. That's three reasons primarily. One is that you have the capital distinction between big banks, the capability of the larger banks to flush their problems much more quickly. You've also got a very subjective kind of qualitative sense that you know many of these borrowers personally, and it's harder to pull the plug. But also, most importantly, the community bank space is incredibly tied to real estate lending. Has been for many, many years, as we know. I might add that this chart, which I've shown many times over the years, had a stark reduction in the small institution, down from 62% just last quarter to 57%, mainly because of that PPP lending that was so stilted towards C&I kind of lending. So that was an interesting effect even on this chart. Even in Florida, as good as loan quality is, for example, here's a perfect example. When I say there's a structural disadvantage for smaller banks dealing with problem loans as they emerge, I think you've got to say, even under still relatively good times as we have, because we're not seeing large inventory of acknowledged problem loans begin to be reported. But even in Florida, the smallest of banks are showing a higher inventory. So again, the board level and management level at banks, I think we have to accept that is a structural disadvantage that smaller banks have in terms of taking on even larger loans down the road. I think we're going to be looking at kind of a new normal around credit management in the near term. Talent assessment is going to be required. I think there's going to clearly be a sense of who do we have that can work out loans again. As you know, much of that talent base is retired or moved away from banking from years past. I do think it would be helpful to rethink some of your policies and procedures. To cut to the chase on that, in many cases, banks get trapped, frankly, by regulators by using your own policies against you. Sometimes those policies may not have been touched in years, and they may not reflect the current environment that we're in. And I do think the current environment that we're in is that the pool of so-called attractive borrowers has by its own nature shrunk because of this COVID environment and the likelihood of a more protracted recovery from it. I think we're going to have to be looking at conservatism without overreaction, stressing without too much doomsday, valuations without fire sales. I think a huge focus on reserving as opposed to necessarily charge-offs we'll be seeing for the next couple of years. We'll close in a moment with some renewed focus on loan reviews, and I think we're, our attachment to or living with government guaranteed loan programs is probably has been codified, if you will, for some time to come now. So from a board perspective, are you spending more time approving individual loans than understanding the aggregate credit risk in your portfolios? I think that's going to really need to be looked at from board perspectives. I think staying in approving loans and looking at just individual transactional loans is like losing sight of the forest for the trees. I think your focus as a board member should be on policy, not procedures. I hope you are able at your own board or your own banks to be able to succinctly define your credit culture. If not, it's a good exercise. Our roles and accountabilities clearly explained, our exceptions documented, mitigated, and is approved. Do you have the appropriate information in terms of your key risk indicators, and is that being shared with you? And most surprisingly, I think the most common example of a board management issue relative to, frankly, trust and credibility and transparency is how many credit surprises are you getting? And I think that is behooving everyone, particularly with the uncertainty we're dealing with. It's going to probably guarantee more credit surprises. So I think particularly management is going to have to be forced into an era of being very vigilant about not looking as if either wittingly or unwittingly that credit issues are not being disclosed or looked at. I mentioned in the overview or in the agenda we did about think circle and think onion. The circle to me is the credit life cycle. Again, this is understanding the difference between transactional credit risk, which is establishing your policies, booking loans as they need to be in adherence to your policies. That's more of your traditional credit analysis. As you move into steps 3, 4, and 5, you're really moving into credit performance at a more aggregate or macro level. And unfortunately, that has almost nothing to do with traditional credit analysis. It's really a statistical game that speaks of how does the entire portfolio perform in an aggregate form of view. And I do think that's, to marry those two is the future of credit risk management. The onion part of it is really, excuse me, what we did building IntelliCredit and how we have built our company around the reality that, number one, we're in more of the non-public idiosyncratic data, but we also need to marry transactional credit risk and macro risk, but we also have to peel down or drill down, if you will, to what is showing from an aggregate standpoint down to the other trends that you'll see. Loan level detail is quite important. One of the other aspects of this is we've added and feel like is going to be critically important, and that is how do we track COVID performance once the coding is over, once the PPPs are over, once the extensions and modifications are over. Now the hard work begins. How are we going to live with individual tracking of these credits that may or may not make it? And how we document that, I think, is going to be a real test of the quality of our credit risk management going forward. And the other piece that we've done at IntelliCredit is to tie that to a loan review. Loan review for arguably 40 years has not really changed as a business model. The regulators understood that it was time to kind of buttress best practices in loan review, came out with the final guidance in May of this year. But it's very, very important that I think that loan review, and the reason that loan review is so critical is that the irony here is that many loan reviews have had to be postponed, samples have had to be reduced, and intuitively we know that's exactly the opposite direction it needs to be. Understandably, it had to be reduced because of the limitations on travel and access to banks to do that. But I think that's going to be a huge focus of credit risk management activity in the next 2 years, is catching back up. In terms of loan review, I would say in closing, is your reviewer talent is experienced at the heart of emerging credit risk? In other words, do they have enough verbal and persuasive skills to frankly go up against bank management to really get at emerging credit risk? Because there is an absolute correlation between early detection of credit and your ultimate losses that you incur. And I think that's going to be an added burden on the loan review staffs to be able to do that. In other words, in good times, just checking documents or having a fairly superficial understanding of credit might suffice, but it certainly won't, in my opinion, in the next couple of years. Does it have any relevance to real-time portfolio risk assessment, which we are big champions of at IntelliCredit? And is it truly independent, of course? That is clearly, and I think we're going to have to deal with the fact that suppressing or postponing a lot of loan review, are we exacerbating loan losses later down the point? And final point is, in terms of, I really do believe this has been made by Shawn and by Scott and others probably today. The conundrum we live in is it's not just about an economic snapback, it's what the credit tail may look like and all the details that will have to be looked at to manage credit risk going forward that I think will be a key part of the challenge today. So I do think in many ways this is not doomsday. I think we've got so many other things going for us in the banking industry that we didn't have maybe a decade ago, but there will be some credit challenges here that I think outlive the economic recovery. So I will pause and close at this point, I guess. Paul, if there's any additional questions, we'd love to answer them.
David, thank you so much, and thank you, Shawn. I love the continued emphasis on being able to tell your own story and use your data rather than have someone else tell the story. I was curious about if you're looking at key risk indicators changing, like are you, instead of looking at maybe 90-day delinquency, are you backing that up to 30-day? Are you backing it up to 15-day? Are you looking at, modifying the key risk indicators?
I think that's a wise way of looking at it, and what we're thinking in terms of that, because the last, and I'll answer it a little bit this way. The last crisis was dominated by net charge-offs, right? Net losses. I'm a huge believer that what we've got to think about in this crisis is far more granular, far more anticipatory than you getting to losses. Things like non-accruals, things like shorter past due notices, early detectors, risk grade migrations that are, and we all have to be intellectually honest around that, right? Again, people tend to not want to be the leader in acknowledging problems, but trust me, there is a correlation, as you well know, Paul, between early detection and ultimate loss.
Absolutely.
So I think we'll be in a different way of looking at it, in ways backing up your exact point.
And Shawn, we got one question. You had looked at JP Morgan's reserve build, and just wanted to ask you, most of us are community bankers. I know you're a director of a community bank. How do you parse the data when you're looking at large public banks that may have adopted CECL compared to community banks that haven't adopted CECL, was much of their reserve build allocated to the CECL adoption, or do you think it was an intentional reserve build with or without CECL? You're muted, Shawn.
Sorry. One of the things that we've done at Quick Analytics is try to, with the publicly traded banks, is certainly find any available information from earnings calls, et cetera, and put those as part of it. And so in their earnings call, it was about 78% was reserve build and 22% was for CECL. So, about 80-20 was actually reserve build. And so that's where we've tried to continue to dig and just kind of see what some of them are doing to just, again, try to read some tea leaves about what we might expect.
Yeah. Well, again, I just want to say thank you both. I've had the honor to speak with both of you at different banking conferences, and I always learn more from you, and I really appreciate the tools and the data analysis that you're providing to our industry. It's excellent analysis, excellent use of the information. And then, Shawn, as I've heard you say many times, we're just missing the boat if we don't take advantage of the fact that in our industry, we have free data in the call report every single quarter, and so many other industries don't have that. So just appreciate your willingness to share with us and the great tools you provide.